Rate cut is one of the few things that signals economic recovery and asset inflation. Once the Fed begins to cut rates and turn on the money printers, you know the bull market has arrived. Will the Fed cut interest rates this September? The upcoming Federal Reserve meeting on September 18th has the markets on edge, with expectations shifting significantly. According to the CME FedWatch tool, there's a 100% chance that the Fed will cut interest rates at this meeting. The only question now is whether the cut will be by 0.25% or 0.5%. The market currently indicates a 72% chance of a 0.5% cut and a 28% chance of a 0.25% cut. Looking ahead, the market is also pricing in additional rate cuts in the November and December meetings, with a total of 3 rate cuts expected in 2024. While emergency rate cuts are rare, they do happen, as we've seen in various situations. One advocate for an emergency rate cut is Jeremy Siegel, a professor emeritus of finance at Wharton. He suggests that the Federal Reserve should immediately cut rates by 0.75%, followed by another 0.75% cut in September, arguing that the Fed funds rate should be between 3.5% and 4%. Currently, the Fed has maintained the rate at 5.5%, but voices like Siegel's argue this is too high, especially in light of recent job reports showing unemployment has risen to 4.3%, the highest in 2 years. The Federal Reserve has a dual mandate to manage inflation and ensure that the labor market remains stable. The recent unemployment data exceeding expectations suggests that the labor market is weakening, which could prompt the Fed to act. The Fed's June projections indicated an expected unemployment rate of 4% by the end of this year, rising to 4.2% by the end of next year. However, the current rate of 4.3% is already above these projections. Given this, it's clear why there's a strong market expectation for a rate cut in September. However, not everyone agrees that the Fed should cut rates. Some argue that the Fed should not be influenced by short-term market fluctuations, viewing the recent market volatility as a natural unwinding of positions rather than a response to an economic shock. These analysts suggest that fears are overblown and that this could be an opportunity to buy the dip. Others warn that an emergency rate cut could signal panic and potentially worsen market conditions. Our perspective is that the Fed is likely to cut rates in September, especially given that the unemployment rate is already exceeding their expectations for 2024, and it appears to be on an upward trend. While easier monetary policy seems likely in the near term, it's essential to remain aware of historical patterns. Although history doesn't repeat exactly, it often rhymes. In the long run, the stock market is expected to rise due to financial asset inflation driven by monetary policy. However, in the short term, expect heightened volatility. Inflation is another concern that investors should prepare for, as I believe it will continue to worsen. The Fed has already reduced quantitative tightening, and there are calls to halt it completely, which could lead to the return of quantitative easing, essentially massive money printing. This will likely fuel further inflation, and it will be interesting to see how the Fed responds when inflation spirals out of control, possibly in 2025 or 2026.